Hi listeners, welcome to another episode of the Premium Investment Leaders Podcast. I'm your host Damien Chilmy, and today we are coming to you live from the 2025 Premium AltInvest Forum, where we're chatting to Claire Smith before she gets up on stage to discuss private equity. And about our guest, Claire Smith heads Schroders Capital business in Australia, which covers all their private market solutions. With over 20 years' experience, Claire's been involved in the development and implementation of structured finance initiatives, funds and investment solutions for both institutional and wholesale clients. Hi, Claire. Welcome to the program.
Thanks, Damien.
And glad to have you back again. This is probably the second or third time I think we've had you on, so it's great to see you again.
Yeah, thanks for having me.
And so we're recording, as I said, for our AltInvest Forum, and we're going to be talking about a lot of different strategies within this space. But you're here to talk about private equity in particular. And I think, people used to think about private equity as providing a lot of funding solutions for smaller to medium-sized companies for venture or growth. But it seems like the deal sizes are getting bigger and bigger. So why you and Schroders, why are you staying in the smaller end of the market?
Yeah. It's an interesting industry that's evolved quite a lot over the past 20 years. So 20 years ago, it was mostly small cap funds, and there was a bit of a joke that you'd do a consumer deal on a Monday, a healthcare deal on a Tuesday. But the market's really matured now, and you've got a lot of specialisation, but also through that journey, you've got a lot of successful funds that have grown very big. And there's a lot of benefits to companies to remaining private as opposed to listing. You can make longer term strategic decisions around a board of directors. Obviously, once the company is listed, you've got a lot of governance, compliance issues. You've got quarterly earnings cycle, ASX announcements if something happens. So I think as the industry matured, companies were seeing this benefit of staying private for longer and so choosing to stay private. But what we find is just by the law of large numbers, it's much easier to double the size of a small company than it is to double the size of a large company. And what we're trying to do with our private equity fund and platform is really provide a diversifier to listed markets. So the bigger the companies get, even in the private space, the more correlated you become with listed markets because there becomes overlap, and sometimes even, the big guys are doing take privates of listed companies. So we really want to build a portfolio of companies that have idiosyncratic company risk in them in that small to mid-cap space and are generally decorrelated to both listed markets and GDP, and that's what I think we've built and delivered.
Yeah, I could see that. Yeah, no, that's very interesting. So we've seen an evolution in deal types from basic 10 years closed-end vehicles, and now we've got a lot of innovation, as you can imagine, in this space. We've got co-invest, secondaries, continuation vehicles, et cetera, et cetera. Yeah, how are you embracing all these new deal structures?
Yeah, we love them all. So we run, the business was built off traditional closed-end funds, so that for institutional clients. We also manage a lot of mandates for a lot of big institutional clients as well, where we let them sort of pick their, choose their own adventure, if you will. But what we realised was there was a gap in the wealth space, and so people who didn't have the ability or the desire to lock up their money for 10 years in these closed-end funds, we built a solution with monthly applications and quarterly redemptions. We obviously still highlight the fact that liquidity is a risk they're taking in this structure. So for our particular fund, it takes 4 to 7 months to get to redeem. So we always try to make sure people come in eyes wide open. But we think we've struck a really good balance where they can get access to pure private equity with just a little bit of cash, obviously, but then still have that, we call it sort of, circumstantial liquidity. So if you want to buy a new house,
it's a new term.
If you want to change your asset allocation a bit, the liquidity will be there. But we do always warn if there's a GFC type environment and everyone hits exit at what we all know is the exact wrong time to exit any sort of fund. That's when there might not be liquidity there. But yeah, I mean, the semi-liquid fund, though, is only about 10% of our overall AUM. We still run 90% of all our private equity money in traditional closed-end funds and mandates.
And so with the semi-liquid, as some of these specific deal types, are they better suited to that semi-liquid vehicle?
Yeah, absolutely. So our semi-liquid fund, so we invest across primaries, so other people's closed-end funds, and then we do direct co-investments and then continuation funds.
Yep.
But the semi-liquid fund has the lion's share of its assets in direct co-investments and continuation funds because they're fully funded on day one. And because we have to manage all the liquidity within the fund, you can't really pack a semi-liquid fund with primary funds because they have follow-on commitments within them, and it's really hard to manage that cash balance. So 90% is in co-investments and secondaries.
Yeah, very interesting. That's good. And so I suppose Schroders are an allocator of capital as well through this. So you get to assess, management quality of a number of existing and probably some newer private equity general partners. So what are some of the characteristics that you seek before committing to a new GP?
Yeah, so we like really specialisation. We want the managers to be specialised in the sectors that they invest into. So we have 5 key sectors: healthcare, technology, business services, consumer and industrials. We sort of joke we want the manager to know more than what we know about those sectors, and we know a lot. So usually they're specialised by sector and often by region as well. One of the things we particularly like and we don't shy away from is first-time funds, but ideally we want a first-time fund with a not quite first-time team. So often we find spin-offs are a really good way to access because you get individuals within funds that have, done, as I said, each fund's a success. They raise bigger and bigger funds and start to graduate into the larger end of the market. But the small to mid-cap segment has historically outperformed that. So some partners within the firm will realise, actually, I can earn more performance fees if I go back to my roots and go back to small to mid. So with that, we like it, as I said, but we do a lot of reference calls. So they give us the list of all the companies they worked on. We find people who've worked in those companies and call them and say, who sat on your board, who was actively involved in the day-to-day management of your business. We call, colleagues from previous firms, what was this person like to work with? And you want to make sure that that team has the right skill set, has the right motivation. But sometimes, on those first-time funds, if you get all those dynamics right, it can be very profitable.
Very interesting. It's something that I think a lot of listeners as well who are allocating to strategies themselves need to think about, what are those characteristics. So great to hear your insights on that. Turning to, I suppose, a couple of portfolio ideas. Got Liberation Day, I think, coming up tomorrow, as it's been termed. So general feeling about that. So that's tariffs for people who may not know. It's a big day, I think, from Trump's presidency. So what are you feeling about that kind of tariff program coming through?
Make America great again. No, we do. Putting aside anyone's opinion on Trump, the good thing about the small to mid-cap segment is these are the companies that are building the backbone of North America. So we invest in Europe, US and Asia within our fund. So these companies we're investing into are the type of companies that Trump wants to support and promote. Also, being small to mid-cap, we're not really investing in companies that are doing international trade. They tend to be very much local to local businesses, especially Asia. Obviously, China's a bit of a interesting region at the moment, but always our thesis in Asia as well has been we want local businesses servicing local customers because we want those businesses to provide diversification again from other regions and markets. And as soon as you've got a company exporting to the US, guess what? You're back to sort of having US exposure. So these small to mid-cap companies across Europe, North America and Asia, from a direct tariff perspective, we're not too worried because, as I said, they're mostly local to local. Obviously, if the trade wars have a contagion effect and it affects the whole economy, then, we're going to be affected through secondary factors like everyone else will. But on the whole, I think, as I said, the thesis of the platform has always been find good quality companies, enter them at attractive prices and let them grow from within. So grow or transform within is our motto. So again, if we've got all these bets across the world in these companies and they're not too correlated to GDP or affected by tariffs, hopefully that'll be resilient. That sounds pretty logical and hopefully it all plays out that way there. You're thinking about AI as well because you do a lot in business services. So everyone, I think, is scratching their heads like, what's the best way to play AI? Well, what are some of your learnings, I suppose, and where you think you can allocate to benefit from this? Yeah, so we've got actually the semi-liquid fund we market in Australia is mostly buyout, so mostly profitable, but it has a very small allocation to venture capital. It's got about 4%, but we actually have a very strong venture capital team. So that's the longest strategy Schroders has been running in private equity. They've got a 28-year track record. So through our venture capital program, but that's mostly in closed-end funds, because venture, you need a lot of time and often follow-on capital to make that, to see the company from gestation through to exit. So it doesn't quite suit the semi-liquid fund structure. But nonetheless, we've got it all in the ecosystem. So through that platform, we've got investments in 3 of the 4 biggest AI companies in the world. We've been, exposed to, I know everyone, when they talk about AI now, they mean the large language models, but obviously AI has been around for 10 years in your Spotify algorithm and all those sorts of things. So we've got a lot of learnings from that team, and that team helps sense check. If you've got a company saying, oh, we're going to use AI to improve this, they're pretty quick to know, is that feasible or not? We do have one AI investment in the semi-liquid fund as well, a direct co-investment that we sourced through the venture capital team. That's a company called Scale AI that actually does data annotation for the large language models. So its clients are NVIDIA, Microsoft, OpenAI, Cohere. So we quite like that. It's almost like the picks and shovels of AI, if you will. You're not taking a bet on which large language model is going to win them, because actually this company services all of the major AI companies, or large language model companies, if you will. So yeah, another bit of an angle on it. But I think, as I said, having that venture capital knowledge within the firm, it helps a lot when we're due diligence in companies, because, the joke, sell me this pen, it has AI, everyone's trying to...
At a premium, I imagine, as well, too. Yeah,
exactly.
No, I could see the real benefits of that platform from the venture capital. So it's really interesting. So Claire, we'll probably wrap it up there. Thank you very much for coming around, and we'll speak to you again.
Yeah, thanks so much.
Thanks.
Premium Limited is the issuer of the Investment Leaders and Advice Leaders podcasts. These podcasts are for promotional purposes only and aren't tailored to individual financial situations and do not contain financial advice. Views expressed by presenters may not align with Premium's. For more information about Premium, including our disclosure documents, please visit our website. We recommend that individuals seek professional financial advice before taking action.